Greetings, folks. John Grace, President, Investors Advantage. And it's a place where we like to help people understand what their money is doing. So we're going to be doing a couple of workshops, primarily for fiduciaries and board members of nonprofit organizations and charities. We do a lot of work with endowments and foundations and 401k plans, and we find that it's often the case that these trustees, these board members, or these fiduciaries don't really recognize what they're in for. That may be the good news and the bad news. So we've identified 5 essential strategies to a better understanding of your fiduciary duties and responsibilities. There's some financial responsibilities, there's some work that's quite rigorous, and there's some liabilities that come to board members that don't come to staff and other volunteers. So we think this is very serious. We've done a lot of work with being on boards, and whether they're local or national, also as advisors to boards, whether they're clients or paid advisors or volunteer advisors. So we've learned a lot about what's important to trustees. And one of the things that we want to make sure that we cover, we'll talk about 3 of them right now, is first, when's the last time you and your board members actually reviewed your investment policy statement? Do you have one? Have you reviewed it? Is it meaningful? Secondly, is the investment policy serving as your investment committee's roadmap? Or is it something you did years ago and you haven't gone back to review it and you don't know what it does and what it's supposed to do? We think that's important. Thirdly, when we look at investments, we find that things are rather interesting, particularly when we look at the average investor from 2000 to 2010 versus the endowments and the foundations. Average investors tend to have a plethora of mutual funds, but the ratios tend to be about 60% stocks and 40% bonds. When we look at the returns for that 10-year period, the average investor may have enjoyed a whopping 1.5% on an annualized basis, which means an account valued at $100,000 on January of 2000 grew to about $115,000 or so by year-end 2010. In sharp contrast, when we look at the foundations and endowments, we see a very different story. First of all, we see, starting with the same $100,000, the foundations and endowments enjoyed a 5.1% return. So with the same starting value of $100,000, that may have taken the account value up to about $164,000 on average. Very different portfolio. A lot of things that the foundations do, the endowments do, that individuals and smaller organizations don't do, but success leaves clues, and maybe we can learn something here. When we look at some of the very large endowments, like Yale as an example, with about $20 billion, we find that the portfolio mix, most folks may have their portfolio stool on 2 or 3 asset classes. Again, we're talking about 60-40, that would be 2. Yale's portfolio is built on 8 different asset classes. Notice, if you would, the small composition or exposure to cash and to bonds and to U.S. stocks and to internationals. How does that compare to your portfolio or your foundation's portfolio? Well, we're not saying that this is a template that all should follow, but clearly, if success leaves clues, maybe there's some things that we can learn from these large organizations that can apply to ourselves and our own organizations. I love the quote from Warren Buffett. He says that the market will do whatever it has to in order to maximize the number of people being wrong. I think he puts it really well. So when it comes to our organizations where we volunteer our time, we don't want to get it wrong. We want to get it right, because at the end of the day, we want to leave the place better than we found it, and we want to make sure that this organization continues to serve in the fashion that we have constructed, whether or not we are here, whether or not it's good times or bad times. So I look forward to your joining us right here at our conference room. John Grace, President, Investors Advantage.